As a new financial year starts, I wanted to take some time to discuss with you some of very important trends that we are seeing in India's fixed income and macroeconomic developments, and what we think are therefore very important implications for fixed income investors. So we basically think that India is potentially undergoing a transformation in its fixed income market. We are on the edge of what may be deemed as a bit of an inflection point. And therefore, at this time more than at any time in the last couple of years, we think fixed income deserves a very important discussion amongst investors. Let me summarize our thoughts and what it means for investors in our view. So there are 4 reasons why we think India is at an inflection point as far as interest rate markets are concerned. And this is for the positive. Our view is that there is a good chance that there is a structural fall in interest rates over the next few years, although the quantum and pace of this will be dictated by a lot of market and policy forces. Also, there are important assumptions in the view, which I will come to shortly. So turning to these 4 factors, the first and the most important one is that there has been a very substantial improvement in India's macroeconomic dynamics over the last few years. And importantly, a lot of this is not just happy circumstance, but also due to policy intentions and executions. There are 3 large parameters when we talk about macroeconomic stability. The first is current account deficit, the second is fiscal deficit, and the third is inflation. Let me briefly touch upon these. To us, the most important dynamic to track, especially in an emerging market context and when assessing long-term interest rates, is the current account dynamic of a country. At a very broad level, it is the difference between investment and savings at a country level. Now, India's current account deficit used to be of the order of around 3% of GDP till not very long back. It only used to compress in the midst of an economic slowdown as investment to GDP used to fall. However, what we are now witnessing is an uptrend in investment, although it's not very broad-based yet, but nevertheless an uptrend, and headline economic growth rate that is doing very well, and yet a current account deficit which is steadily been compressing, now to the order of 1% of GDP. This has very important implications for the direction of long-term interest rates, because as the difference between investment and saving compresses, in economics we know that this means lesser pressure on long-term interest rates. The second is fiscal dynamics. Now, it is to be noted that unlike many in the Western world, India's fiscal response to the COVID crisis was measured, well thought through, and administered in a sequence which preserved macroeconomic stability. Not just that, the fiscal compression or the path towards the commitment towards fiscal compression that the government has shown, especially with the path shown in the most recently concluded interim budget, is truly admirable. It is also to be noted that the 3 factors that I am talking about, which is current account, fiscal and inflation, should not be looked at independently, but they are correlated and intertwined with one another. As an example, a well-behaved fiscal trajectory, keeping other things constant, keeps government's dissaving in check and therefore has benign influence on current account dynamics as well as on long-term interest rates. Turning to the third factor, which is inflation, again because our fiscal dynamics were well thought through the COVID years, we didn't overstimulate the system, and monetary policy acted proactively to first tighten rates and then also simultaneously to start to preserve expansion in balance sheet, or rather ensure that balance sheet of the Reserve Bank did not grow at an extraordinary pace as it had over the COVID crisis. So a combination of fiscal and monetary response has ensured that our inflation trajectory is on a very sustained path towards 4.5%. Even if you were to look at the split of inflation today, it is largely owing to the volatile food prices that the headline inflation is fluctuating around the 5% mark. if you strip out food or just some components of food, you can argue that India's inflation is already close to 4%. Again, notably, it's very different from what parts of the Western world, chiefly the US, are experiencing, which are very, very sticky services inflation, owing to those countries, and again particularly the US, having been very loose-fisted with fiscal policy over the last few years. So this constitutes the first broad point that I wanted to talk about, which is owing to the evolution of the current account, fiscal and inflation dynamics, India is experiencing a re-rating of its financial assets in terms of risk profile of these assets, especially in the eyes of global investors. We have probably already started to see that in equities, but our belief is that it is now more and more starting to get felt in fixed income as well. So in some sense, from being considered as a high-risk emerging market not very long ago, India is now definitely a choice or a top pick amongst emerging markets when investors want to allocate capital here, and it is more and more being perceived as a very low-risk emerging market. Turning to the second broad point, this transition in India's macroeconomic risk framework is happening when the country and the size of the financial markets is growing by the day and is now at a size which is truly, financial investors globally are unable to look the other way. So think about it this way, that if you are a relatively small size country experiencing a very good macroeconomic story, a lot of financial investors globally may either allocate a very small part to this story because the capacity is not that large, or they may ignore it altogether till the story is large enough. But that's not the case with India today. It is steadily heading towards a top 3, top 4 economy in the world. It is also a very large financial market with the ability to absorb a lot of foreign capital flows, which basically tells how deep the market is. So that's the second point, which is that this economic transformation is happening when the size of this market is now very large and difficult for foreign investors to not pay attention to. Third point, particular to fixed income, is that this bond index inclusion that we have seen, a large index and one small one, and hopefully more to come over the next 2 to 3 years, is almost forcibly getting foreign investors to look at the market. So not only is this a very large and very well evolving story as we discussed, but even if, let's say, some investors had certain operational or technical issues in terms of setting up shop here, they are more and more having to look at this because of the compulsion to invest owing to the bond index inclusion. However, notably, we look at the bond index inclusion as just a facilitator, and had it not happened even, India would have still gotten its fair share of foreign capital flows because of points 1 and 2 that I discussed. Point 4 is, more and more, there are only those many large global macroeconomic stories to invest in, and that is especially because, as I alluded to before, US fiscal dynamics are being conducted in a fashion which is probably piling up long-term risks for that economy. As an example, not only was the US very aggressive in its fiscal response post-COVID, but quite confusingly, today when that economy is growing at around 3%, still fiscal deficit at a center level is tracking close to 6%, which is more what an emerging market should be running, not a developed market. Now, in the near term, this economic strength basis the large fiscal stimulus is contributing to strength of the US dollar. But over the medium term, a combination of high fiscal deficit and a high current account deficit would probably still lead investors to look at other non-dollar stories over a period of time. And part of it is already happening. You can see how, let's say, bond spreads between emerging market and US have been compressing. But we think that this will continue to happen over longer periods of time. So to summarize, India's macroeconomic transition is well underway, thereby cutting risk premium. We are now at a scale which is very difficult to ignore. The bond index inclusion is almost forcibly asking investors to look at the story, not that any force was required given how the economy is shaping up. And more and more investors are looking for large global stories to allocate capital to, partly because of US fiscal dynamics, which don't look sustainable at all. Because of these reasons, and mostly because of the first two reasons that I mentioned, we think that India may be at the cusp of a structural fall in interest rates. Again, like I said, how much we can't assess today depends on a lot of global factors as well as evolution of local policy. The risk factor or assumption that I mentioned before is that a lot of it is because of policy initiatives and execution, and therefore we are assuming continuity of thrust and focus of this policy both from the government as well as the Reserve Bank when we form and execute this view. What does this mean for investors? We think the number one risk for investors today is actually reinvestment risk, or the risk that your fixed income maturities that will happen over the next 1, 2, 3, 4 years, you may find interest rates at that point are lower, and therefore you are reinvesting that at a lower yield or interest rate. And we think investors have to take active steps now in order to mitigate this reinvestment risk that may creep up in the future. A clear way to do this is to expand average maturity of your fixed income assets. And when I talk about fixed income, it is actually the entire gamut of your fixed income assets, not just restricted to your mutual fund investments. So when you assess what your average maturity today is, you have to assess this for this wider pool. And the incremental investments that you make have to ensure, in our strong view, that the average maturity of this pool gets lifted so that you are mitigating future reinvestment risk for yourself. There is no one size that fits all, and therefore there is no one fund or one strategy that fits for every investor on an incremental basis. But like I said, what one has to note is that steps have to be taken so that the average maturity of the entire pool gets lifted so as to mitigate future issues soon again.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.